Welcome to the new Barbarians Podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Hello, everyone. This is episode 37 of the new Barbarians Podcast. Today's Monday, September 29th, 2025. The podcast will hit the platforms tomorrow morning. Today, we're joined by Aaron Brown.
Hello, everybody.
Last week, we had strong economic data. New home sales came in strongly above expectations. The final estimate of GDP growth was increased to 3.8%.
Bill, can I interrupt you for a second there?
Of
I
course.
think people don't pay enough attention to the size of the revisions, which to me are more important than the number itself. You know, we're now getting Q2, so it's 3 months after the end of Q2, right? It's actually the end of Q3, and we're getting the third estimate, and it's 0.5% off from the initial estimate, which came out a month after Q2. And the average difference, the average absolute difference is 1.3%. So actually, this one came in pretty close. It came in, closer than average. And that just tells you something. The same people using the same methodology, just with a little bit more data, can't measure GDP growth more accurately than on average, 1.3%. And for an investor, if you're trying to figure out, well, gee, what's the true value of an equity? And you can't tell, and you have to guess the average future growth rate over the next centuries. 50% of the value of the S&P 500 is for cash flows more than 65 years in the future.
All right, Aaron, stop right there, because you lost not only me, and I'm doing this for a while, but you've lost 90% of our audience. Guys, we were talking about this before we went in. Aaron he doesn't nod his head to data. He looks at it. Go into equities. There's $58 trillion of values. There's earnings. What do you mean by 65 years in the future? What does that have to do with the S&P?
Well, the simplest model of equity valuation is, you buy a stock for the cash flows. Now, obviously, most people don't. Most people buy it for what they think somebody will pay tomorrow. But if you're, if you're a fundamental investor, you're Warren Buffett, you're David Einhorn, somebody like that, you're looking at the cash flows and the present value of all the cash flows. Well, in order to get the money you pay for a stock, if you buy the S&P 500 back 65 years from now, if you add up all the dividends you're going to get over the next 65 years, you've got half your present value back. And you're guessing, you're guessing what they'll grow with, but they could grow twice as fast or half as fast. We're trying to guess what will happen. If you're a stock market investor, a fundamental stock market investor, you're trying to guess the long-term growth of the economy for the indefinite future. And economists can't even measure what it did, 3 months ago in the past with all the data. And we're not even talking about the difference between reality and what they say. We're talking about the difference between the same people with the same, methods, just with 2 months more data, are on average, move it by 1.3%. If you knew economic growth was going to be 1.3% more than expected over the next few years, equities would be infinitely valuable. It wouldn't matter. You could pay any amount for them and you would get your money back. If you thought it was going to be 1.3% less, equities would be worth 60% less. It'd be a 60% stock market crash. So stock market investors have it a lot harder than economists do. Economists give themselves, pat themselves on the back for these estimates that are so inaccurate, they're just useless for any sort of investment decision making.
So we started that with estimates. And your point was that they're more important because we call that the delta or the second derivative. Is that right? Or is it it's a first derivative?
Well, it's not truly a derivative, but yes, it's a change. It is a change. The thing is, I say it's not a derivative. It's not a change in reality. It's a change in what economists think. And that, somebody who can't tell you the growth rate within 1.3% doesn't know anything useful for investment purposes. And yet, this is what drives our monetary policy. This is what drives our economic theories. People spend, not just individuals, thousands and thousands of economists spend their entire career trying to relate the growth rate, unemployment to inflation and things like that. And they don't know anything about those things.
And all of
They,
them
they, they make all
are
these
in.
numbers so they can build models for these numbers that they've
Yeah.
invented.
Well, they'll continue because this is going to tear up the script stuff. And because when Bill's used to me going 5 minutes in the markets, and we're going to play a little ping pong with some ideas here.
So yeah, thank you, Aaron. I think that gives us a little bit of a preview into what we'll actually talk about, what you've actually been up to lately beyond criticizing economist estimates. Economic data this week left the door open for fewer Fed cuts because, these were revisions to the upside, which is good for the economy, bad for, short-term stock market sentiment because that's primarily driven by the expectation of the Fed either increasing or decreasing cuts. And so the probability of further cuts came down a bit, which, sorry, that's Buster again.
Buster's not happy with the changes in the projections at all. He wants firm numbers and maybe some biscuits. Aaron, I know that when you're a risk manager, data is very important. It's not the place you end on, but it's a good place to start once you validate it. And at Risk Dimensions and working with this podcast, there's too much information. So what we did is we got this data from this company called Financial Modeling Prep, and we have an analyst in Austria who's in charge of taking in all 200 data sets or metrics each week. And I'm going to share my screen now with everybody because I use Chrome, Bill, thank goodness. And I'm going to show you what we put out every week for the last 5 weeks. I'm not even going to tell you how long it takes them, but we look at all 3 regions. This is to our audience, and Aaron, I haven't showed you this, but we take the week, we blow it up, we look at APAC, we take the dozens of releases and we say, let's look at 3 only. And then we give you a few more in a little extra bag there. So Japan unemployment, we give you the previous, a consensus. We give some context and we tell you why we chose it. And then we give you kind of an insight, a little bit of perspective. And we, again, do this for each region. So France.
Can I make a comment about that, by the way?
Yes.
Yeah. So when I say I don't think the numbers are worthless, right? If the unemployment rate is high, labor conditions are tough. People are having trouble finding jobs. People don't get raises. When GDP growth is high, that usually means things are pretty prosperous. But think about the unemployment rate, right? So you take the number of people unemployed looking for work and divide it by the civility, or you divide it by the sum of the people employed and the unemployed looking for work. But if you really think about it, there are dozens of different categories, right? There are people who are employed, people but hate their jobs, people who are employed but don't expect to keep their jobs, part-time people who like more hours. And, when you sort of boil that down to one number and aggregate it over the whole country, I mean, really there are regions, there are sectors with unemployment high or low, there are types of workers in demand and types of workers not. When you put it all together in one number, you just aggregated out all the real information. Now, granted, economists look at a dozen different unemployment indicators. They look at payrolls, they look at non-farm, they look at civilian and so on. But even with that, the economy is just much, much too complex to boil it down to one number as anything other than a general indicator. Now, if you're a trader, and I was a trader for much of my life, you don't care about any of that, right? The number is going to come up, and based on the number, how things are going to move, and so you're, betting and positioning and things like that. But you're reacting to the number itself, not to any underlying real reality.
Let's just say that you're dating the data. Yeah, it's not a long-term relationship.
You're dating the data.
And hopefully it doesn't date you back too hard.
Mm-hmm.
And it's perfect. And I think what you're talking about, not what, I'm not going to say what you're talking about, what you said brings to me is, the mosaic, creating, understanding the system by using the data, which is maybe the best approximation of what's happening, to create the system and then deconstruct it. So you look at unemployment, and if you look at unemployment over time, 4.3, Aaron, is pretty low. It's in the bottom quartile or something like that in the U.S. over the last 50 years, bottom third, I think. But the participation rate is historically low over the past 40 years.
And let me throw out something else. In 2025, I expect there will be more gig work than full-time traditional paid employment in the US. And none of that is reflected in any of the unemployment numbers we've seen, right? We just have not updated it. And gig work makes the concept of unemployment different, right? It's completely changed. And so, you're saying it's in the bottom quartile or bottom third, I've forgotten which, historically, but being unemployed in 1950 was very different from being unemployed in 2025.
Yeah. And I meant the unemployment. So we have a very high employment rate now, but
Of people, if you exclude the
counting.
people who aren't, who haven't given up looking for work, or students, or military, or government workers, all of this excludes the government, agricultural workers typically. So, you're really talking about a pretty esoteric statistic there.
But it's a number we
But
love
I
and
do
look
say,
at,
I
right?
do want to remind people, it is meaningful just as kind of a general indicator. If even if it doesn't really relate to any specific reality, yeah, when the number goes up, the unemployment rate goes up, that's bad for workers. And when the unemployment rate goes down, that's good for workers, but sometimes tough for businesses.
What's an example, Aaron, of you more recently looking at data and saying, okay, that's the headline number, which everyone looks at. I'm going to, my words, contextualize it. How do you use it to get more actionable or insights out of it? Or do you have a very different process?
Well, there's an old saying that, the plural of anecdote is not data. But actually, I put more faith in anecdotes. You get a bunch of, get a lot of real things you can trust. Are people grumbling in the supermarket line? If you still go to supermarkets, gas prices, you just go, take a look, gas prices when you look around, what are people saying? Do people, do they seem worried about, can they get a new job? And if so, what and where? Um, these things, I think, in many ways are more interesting. And by the way, for about 10 years ago, we started getting lots and lots of this big data. So, you got satellite pictures of supermarket parking, of mall parking lots, and you've got, just masses and massive data that you're running through computers. And we're finding out a much richer picture of the economy than we ever had before this way. So the headline numbers are, I'd sort of it's like the batting average of a baseball player, right? I know how much you know about baseball or sabermetrics, but batting average is a terrible statistic. But yeah, I mean, a guy who hits 300 is probably a better player, more valuable player than the guy who hits 250, even though there are much, much better ways to measure things. So I put much more emphasis on anecdote. And in terms of the numbers, as a trader, all you care about is the difference, right? If I knew Q2 was going to be revised upward 0.5%, that's meaningful. I could have made some money on that. If I knew it was going to be 3.8%, who cares? 3.8, 4.8, 1.8, it's all, that doesn't matter. So that's why I say you pay more attention to the numbers. And you ask yourself, what happened? What data came available in September that made such a big difference? And if you, dig down on the weeds of how they estimate the stuff, and you start saying, why is this stuff coming in? Why was all the good news coming in September that wasn't available in June and July, or July and August? So these are the kinds of things I looked at. I don't do much of this today because I don't do any macro trading today, but it's the kind of thing I find interesting.
I was flippant when I said it's meaningless anyway. You were correct. You were right to correct me in saying that it is meaningful as a general indicator, which you can then say, it isn't as meaningful as a lot of people perceive, these headline numbers, but the revisions
Well,
certainly are.
the thing I would say, if you have enough memory to remember back to the Joe Biden administration, with the exception of the inflation number, most economic numbers were coming in pretty darn good, and not great. It wasn't like the greatest, it wasn't like the Reagan miracle or something like that, but it was very solid, good performance, the kind of thing. But nobody trusted it, right? The mood was all sour. It was all like things are fragile, and we're about to go into recession. We're about to go into hyperinflation, whatever. And that disconnect is important for a trader to think, okay, so the numbers are okay, but people aren't happy. What's going on? Now it's much more partisan. right? So there are people I feel like who are professionally unhappy because of their political beliefs and people who are professionally happy because of their political beliefs. I don't see a lot of good, honest economic feeling. And I find it very hard. I find it very confusing. I don't get a sense, I mean, if just random example, I'm going into the supermarket. This is just today. I went to the supermarket and they had these beautiful pieces of salmon for $5.99 a pound, which is less than half the normal price. I'm thinking, wow, okay, prices are really going down. Food is going to, and then I look over at the steaks, and the steaks are $28 a pound when they should, they were 20 a week ago or something. I'm saying, wait a minute. So what's going on? Why beef and not salmon? And I talked to the guy at the counter a bit, and he was saying, yeah, our fish suppliers are pushing us, and we have to pull teeth to get beef. So, something's going on there. And, if I were back in, there was a time in my life when I would, start digging into this and say, okay, what's going on? Is it happening everywhere? I don't know that, by the way, but
well, maybe you can't jam 10,000 cattle into a pen and feed them a bunch of bread like you can to the, to the fish.
Yes, this was not wild caught salmon. This was, which I normally don't buy the farmed salmon, but $5.99 a pound. I can eat salmon salad. I like it.
Aaron, when you were talking about if you knew the number was going to change, you would know as a trader, the difference versus the number you'd be set. How when I look at data and for the non-traditional or for the layperson in finance, how much should they care about unemployment in planning their life or inflation? How should they plan their lives based on their job to fund their kids' education, to plan for maybe a vacation? Like how are people able to use data to make good decisions just to manage their life?
Well, let me start with sort of the finance 101 answer, which is, okay, well, you plug in expected inflation and, you put your spreadsheet and just multiply. And in that, simple models, right? Your wages, your costs, your house price, everything goes up with this number. Well, if that were inflation, nobody would care about it because it would just be, it would just, fall out of every calculation. So you got to get away from thinking about it as a single number. You have to think about the things you want. For example, we know that education and healthcare inflation has been much greater than general inflation. We know wage inflation has been slightly higher than, wages have gone up slightly faster than inflation. But we've had long periods where wages have not kept up with inflation, and then they kind of jump up and do it. But there are other things, obviously, some things are obvious, like computers, or everything's getting a lot cheaper. So I kind of think for most people, middle-class people, the big tickets are housing prices or rent if you're renting, and education. Healthcare, yes, but you can't do much about it. Healthcare is kind of in the province of other people. And those are the things you really want to focus on. For a first approximation, it's not a bad to say, okay, well, there'll be inflation on my wages will go up, my costs, my food, my clothing, those things will go up in price. But we know that a small inflation expectation can send gold or housing prices soaring, and a small decline in inflation, a little bit deflation, and suddenly, real estate is frozen. You can't sell your house, or you have to cut the price 50% below market to get any buyers to come look at it. Gold can crash. So these are the things. The other issue is, people look at the CPI, but the CPI and economists don't, right? Economists don't pay much attention to the CPI because it's dominated by food and energy, and food and energies, spiral up and down for all kinds of supply reasons. That's not inflation. What you want to remember is we measure inflation by price increases, the way we measure a fever by your body temperature. But we don't care about your body temperature. We care about the underlying medical condition, the infection that's causing it. If your body temperature is too low, a degree or two, there's no problem. If it's 5 or 6 degrees, you start getting hypothermia. If your body temperature gets above like 104, then it start doing tissue damage, and that's a problem. But in between, we don't really care about body temperature. We care about what's causing it to go up. So rather than worrying about inflation, say, inflation is not an increase in prices, it's a decrease in the value of the currency. And the worst case is the currency is going down in value because people are losing faith in it. And that's the thing that can spiral. That's the thing that can kill you. That's the thing that can kill an economy. If prices are going up as they did during COVID because of supply chain problems, higher labor costs, things like that, that's really not much of an issue. If they're going up for kind of various sorts of technical, people still like the currency, but they're spending more and saving less. So, if they're doing that, there's more demand for goods, and capital is more expensive for businesses to supply the goods. So those are really things you don't care much about. Unless, if you're a trader, you care about everything. But if you're, just for the normal middle-class person, that doesn't matter to you.
Let me throw a little economic baseball at you here. I'm going to throw you an anecdote. I believe that this is the first time that police have been called to a Ryder Cup to address a crowd. And this is not the first time, but it may be the first time. Hazleton was a potential where you had players, the gallery yelling during the shot and during setup. So the
I have a
behavior.
question. Do the police have bullhorns and they whisper through them like this?
That's so funny.
Break up now.
No,
Yeah.
it's not like that. No, they don't say, come this way, come this way. So you had I looked at it, and Aaron, I'm actually writing a piece about this now. The behavior at Ryder Cup, I think, is very telling. You had the last bastion of group civility, which was immediately, as soon as that sign went up, even at the dreaded blockbuster Phoenix Booze Fest of a golf tournament after the Super Bowl or before the Super Bowl that they have in Phoenix, they even observed the rules. But this broke down. It became tribal. It became rude. And you even had an announcer advance the chant of F you, Rory, someone paid by the PGA with a bullhorn on the first tee. It was bizarro, Aaron. So when you look at anecdotes,
they weren't saying, let's go, Brandon.
They weren't saying, well, that might have been on the second tee. There was a lot going on that day. I couldn't keep up, Aaron. Jeez.
Was there some sort of was there like an Israeli golfer and a Palestinian golfer, something like that? No.
It wasn't that. It was, that's the point. It wasn't like Rory came in and stood on a political item. The only thing Rory's done this year is win the Masters and get the monkey off his back. I mean, it was bizarre how quick and ready the crowd was to engage in, I think, beyond untoward behavior. So when you look at the economy being maybe better, I look at that behavior and I say, there's something missing in people's lives that's causing this behavior. There's where they're ready to fill it with this kind of behavior. That's my 5 cents. I don't know if you've seen it.
I didn't see it. I didn't know anything about this, but I absolutely agree. If I were macro trading, I would be all over this. This is the kind of thing that signals that it means people don't know what's going on. Not necessarily the people on the golf course. They might know perfectly what's going on. I wouldn't talk to them. I mean, one of the things I love to do is, if I don't understand something, I want to talk to the people doing it. Back in 2015, I talked to every Trump supporter I could find. How could you, vote for this guy? And I learned a lot. And I learned a lot of stuff I never would have thought of. My guess is if I talked to some of these golf fans, I would find. I don't golf, and I don't, never. I tried it a few times, found it intensely frustrating, and thought I have better things to vent my frustration.
Time better spent. Yeah, that's it. Yeah, when you said about the Trump part, and what I like about your work is that you're going, behind the numbers. I think that might even be, is that the name of a recent piece you did about bad numbers and
Wrong Number. Wrong Number is the title of my book that's coming out this spring, and I also have a bunch of videos using that title, which was not. It was suggested to me by a branding officer at Reason Magazine. We went through a whole bunch of different ones, and that was the one that resonated.
Cool. Well, I can think of a few song covers to put in, and the old ringtones as far as marketing for your book. But yeah, Bill, sorry, go ahead.
Sure. No, we have a phone on the cover, and there's a movie. Sorry, Wrong Number. There's a bunch of tie-ins.
So I guess to just segue back to a more formal interview, I should have said
during the interview at all.
Yeah, I should have said during the introduction that I did work for Aaron at AQR from I think 2013 to about 2015, right into the beginning of 2016, and it was a rare opportunity to actually go in and work for someone where you've read their book on the subject that you're about to work on. So I read Red-Blooded Risk, and I believe one or two other books, and I've read several over the years. But it was kind of cool to sort of know your thoughts, Aaron, on risk management before I worked for you. And one of the main things I remember was your belief that you need to go and talk to someone rather than just email them to get an answer to a question, because you can learn different things from their answer. And I think in your book especially, and going all the way back to your early days in risk management, I think you were trying to control people who may be taking outsized risks, and you may actually be questioning their sincerity with their answer about certain risks.
Yeah, not and I want to make one very important point. You spend more time telling people to take more risk, but smarter risk. Usually, the untrained people avoid way too much risk, and then they take a few crazy, ones that they don't really get paid enough for. Professional traders are better, but I even have a paper on this subject. Even sophisticated, successful professional traders bet more when they're wrong than when they're right. So just getting people to equalize your bet size. Don't, when you're sure of a bet, it's usually for a bad reason. It's because fear and greed are screaming in your head and, whatever. When you just kind of have a hunch that, this seems like the better side of the trade, that's when you should be, that's when you can bet the ranch on it. But, one of the things we do is just trying, okay, equalize your bet, take the same amount of risk every day, the day you feel good, the day you feel bad. And we can show people make a lot more money when they do this. Most traders talk about we have high conviction, so we'll bet a lot. Let's just track it. Let's track it for a few months and see what happens. And gee, look, all your high conviction bets you're losing money on, and all your low conviction bets are what's keeping us afloat. So yeah, this is the kind of thing. So we really want people to take the right risk and to be getting paid for it.
Is that because of sizing, Aaron, on that? When you said, when you're in that low conviction, when you're not sure, you're equivocating, do you want that person to have the exact same size in that bet as the high conviction one?
Well, that's what we start with. We say, look, that's our default case. And then let's learn how to size our bets. You've learned a perverse bet sizing strategy. And it works with people. It's inside your head. The way I look at it is you got dozens of voices inside your head. You got some quiet ones and you got some loud ones. And the loud ones don't know anything. The fear and greed are just terrible, terrible. Just you got to tune those guys out. But the quiet ones, you don't quite know why, but they're just, market doesn't feel right. It's a Ryder Cup. The Ryder Cup event was inconsistent with my view of the world, so something's a little screwy here. And with institutions, institutions, we tend to give people power based on their claimed confidence and the loudness of their voice. So, you got three guys shouting, I know we gotta go long, my size is your size. And then you talk to people quietly and you find, 60% of the people think we should really be short here. And they're not very sure, and they don't have, they're not trying to beat you over the head. I'm sure I'm right, and here's the reasons why I have to be right. They just say, I'm looking at the numbers, they just look kind of soft. Well, I go, a rule of risk management is to pay attention to the median quiet voice. So tune out all the loud ones. Don't worry about how confident people say, if somebody says, 40% of the people are 80% sure and 60% are 45%, it's probably under 50%. It's that median quiet voice that's the most reliable.
Well, I like the response that, typically a risk manager is thought of as, managing risk, which might mean taking it down, but you're just reiterating that you should take the appropriate amount of risk and not listen
we chose
to
this name, and so the late 80s, early 90s is when modern financial risk management was born, and it was on Wall Street. And we chose to name risk management very carefully. We didn't want to do danger minimization, which is what most people think of, because opportunity is risk. Risk is uncertainty. That's two-sided. And you want the right amount. Risk to a financial firm is like energy to energy to an engineer. You need it. It's what makes everything run, but it can burn you, it can shock you, it can blow you up if you don't handle it right. So we said we're going to manage the amount of risk. But unfortunately, that kind of got lost, and people started, treating it as danger minimization. Regulators came in, and regulators weren't interested in everybody taking the optimal amount of risk. They were interested in nobody blowing up. And so the field kind of hardened into what we were trying to break away from. There have always been danger minimizers. There's always been insurance guys who come around and tell you, okay, cover up that electrical outlet and, cover that cord and get rid of that flammable stuff in the warehouse. And that's all good and useful stuff to do, but it's not risk management.
And it is also informative that you're a former trader and poker player, and you've definitely managed
Yes,
your own risk as well
I
as.
learned this stuff in poker games and casinos and in trading floors and things like this. And I get in a lot of trouble for saying this, but you can't learn it anyplace else. You need thousands and thousands of independent, objective validations of how you're working. If you're an academic, you can go your entire life without ever having a clear objective test of anything. And so you never have to change your mind if you don't want to. You might change your mind, but you don't have to. It's this thing, because these thousands and thousands of events and betting personally meaningful stakes on them. If you don't bet, you don't really have it. There's the saying I've forgotten. There's an economist who came up with. He says betting is the tax on bullshit. And if you're not willing to bet, if you haven't done a lot of betting, I don't know of any other way to get rid of the bullshit.
Well, one decent segue into the wrong number questions would be illustrating an example of myself as a risk manager at a quantitative hedge fund. If someone's P&L was outside of expectations, defined as statistically significant, that was one of the things that you had me chase people on. And if I recall, if someone had, very large P&L today against expectations, if their response to you was, my strategy is kurtotic, you were typically not satisfied with that as a response. Is that accurate?
Yes. So that's for those of you who don't know, kurtotic it's fat-tailed. It means you have more extreme events than you would predict by what we call a normal distribution. So a kurtotic strategy most days doesn't move much. And the few days it does move, it can move a lot. And by the way, Nassim Taleb made both a personal fortune and a career out of saying, look, that's always the way to bet. That people underestimate the chance of nothing changing. They underestimate the chance of a really big change, and they assume that on a normal day, things will move the average amount. But that's the thing that never happens. Things never move the average amount. Only on average do they move the average amount. And that's fine. I mean, that is a good attitude to have, but you have to understand the reason for the kurtosis, right? I mean, that's what we pay the huge salaries for these researchers, portfolio people, to figure out why things are kurtotic.
And is your estimate for tomorrow's volatility good given what we found out today about your observation?
Yeah,
right?
yeah. I mean, is this the first step to a major realignment, or is it kind of a spike that's going to revert tomorrow? I mean, that's the kind of thing you really want to know. You should be paying attention. It's a very common thing in academic things to throw out the outliers. So you look at all your data and you throw out the outliers. Well, usually the outliers are the most interesting thing. The Ryder Cup riots, those are the things that really give you a lot of information. The fact that, there was an NFL football game and there were the normal amounts of fights in the stands and drunk fans, that doesn't tell you anything.
So the wrong number series, I think, is along the same lines as, the researcher says, it's kurtotic, perhaps they haven't done adequate investigation into their strategy on that day. And that would be the case with some academics. So can you just tell us a little bit more about what
I'd say
inspired it?
really, a very, very common thing is, academics, and by the way, there are career reasons. They almost have to do this. No academic or only a few superstars can do enough high quality work to get the number of publications that you need for career reasons. So you have to put in some of these kind of nonsense studies. And many fields of science do fine, because what you're really doing in science is you're building what I would call a woven wave of guesses. And you can do that with a lot of bad threads. You don't need every thread to be strong as long as things sort of weave together. And the threads that don't fit in just get discarded and thrown away. But you do a study, and what the journal demands is a clear-cut, statistically significant result. But in order to get that, you got to throw out the outliers. You got to, fill in some data, guess some data you didn't have. You got to, kind of torture the data and things like this. What you should be paying attention to is that stuff you had to throw away. And you should be investigating it until the point you have a result that doesn't need statistics. As Ernest Rutherford said, if your experiment needs statistics, you should have done a better experiment. If you keep working, people work until they've got a statistically significant result, usually by, hacking and torturing and throwing out outliers and things like that, and they publish and declare victory. You really should keep on going until you have a result that's so clear you don't need any statistics. It's just, the pill cures people. You give the pill to 1,000 people, and 5% more get better than did with the other pill, and you say, okay, that's statistically significant, I get stopped. No, you go, who did it work for? Who didn't it work for? And eventually you find, okay, if we give it to these people, they always get better. If we give it to these people, they never get better. And then, you can fire your statistician. You've got to find him.
Aaron, you're talking about statistics, and if you want to publish something and you rely on statistics alone, that's not waste of time, but that's lost in the sauce for me to interpret what you said a little bit.
Well,
right?
you haven't finished. The statistics point you somewhere, but it's not like it's random whether a pill cures somebody or not. There's a reason for it, and you, by calling it statistics and looking for that p-value of 0.5 or 0.05, as we call it, you've given up looking for the reason. You're treating things at random that aren't really random. This actually go ahead.
This is about process, and the reason I'm going to, Bill, tell me if we're in the hole yet. The reason I want to focus on it is Bill just put out an ad on LinkedIn. I don't know, 2 days ago, Bill? Something like that, Friday or Saturday. Said, Listen, we're just two guys on a podcast, and we're trying to make a go of looking at digital assets and AI. We think they're both two big drivers. We need someone to help us with an agentic approach to our production. We have 1,000 work streams. We need over 100 qualified people in a minute. I think there's so much going on that people don't know how to approach something. So what I'm going to ask you is basically begging the question a bit, because it's talking about how I'm approaching it. And I want to know if you do it in your work with Bill and now. Statistics are a tool, but do I bring first principles to a situation and reevaluate my process? What's my value, Aaron? What's your value? When you were at AQR, were you able to find the wrong number because you found your durability in your process? Again, I use the word first principles. So that didn't matter what you're looking at. You kept looking until there was a certain set, either stomach or whatever you called it. So that's my question and advice maybe to our listeners is there's a load going on here. There's riots in Long Island on golf courses. There's, talks of everyone losing their job. What process, how would you, if you're 22, approach this when everyone's shoving stats and tools down your throat?
Yeah. Well, if I'm 22, I've got, the future's unlimited. It's you have
it'll be a different day.
Incredible opportunities of any generation in history, and you're going to be looking back in 10 years and thinking, boy, I was born to cavemen, and now I'm in 21st century flying around in my flying car or whatever. But yeah, I would say the process I use is you start simple. You say, okay, what's a simple model of how the world works? People are polite on golf courses. The stock market goes up 10% a year. The government squabbles, but things kind of seem to, muddle along without too much trouble. And you say, okay, well, what doesn't this explain? What are the things that are jumping out at me and saying, okay, something's wrong with your model? And those are the valuable things. And you go and you track them down and you try and explain them. And then you come up with a more complicated model, but it never ends. It's not like maybe someday for someone it will end. It's never ended for me because, yeah, you say, okay, now I understand what's going on, but that raises a whole bunch of other things. Why are these things going on? And it is this process. And statistics are very useful for sifting through and finding patterns that might not be otherwise obvious. But you can't stop there. That's the thing. So many papers just stop there. Yes, we notice something and it's statistically significant. The thing is, okay, so why is it that way? Because it isn't random. The world isn't random. This is something Ed Thorpe, a good friend of mine, taught me. Ed Thorpe's the black mathematics professor who invented blackjack card counting and also did a lot of other stuff, including with Claude Shannon, who's the father of information theory. They built the world's first wearable computer to beat roulette. And, what Ed taught me about this, he said, look, all the opportunity in the world is finding the randomness in things people think is deterministic. The errors, they think it's deterministic, but, there's some randomness in there. And finding the determinism in things everybody else thinks is random. And these are the secrets to, this shouldn't be secrets really, they're pretty obvious. This is how you find opportunities, is to look for these things. So I'm constantly looking at things, everybody predicts this should happen, but that happened. And it wasn't random. There's a reason for it. And everybody treats this as random, but it isn't. There really are, the weather seems pretty random, but no, there are patterns. And sometimes there are opportunities with it. And in any case, they help you understand it. It's explanation you need.
So since we did bring up weather, I have to ask you about the rat population in New York, which was one of the videos that I watched in the wrong
Well,
number
New York,
series.
there was 16 cities, right? So ratpocalypse. So
Well,
here's the study.
sorry,
Go ahead.
I shouldn't have said New York. I believe that is where you are right now.
Actually,
so
at the moment, I'm in Las Cruces, New Mexico, but I do have an apartment in New York, and I spend a lot of time there. No rats in the apartment.
Good.
But bugs, we have some bugs now and again, but no rats. But yeah, so here's the thing. It's a study. It got a tremendous amount of press, and it, said, okay, climate change is causing this enormous explosion in rat populations. Okay, all kinds of problems with the study. I'm not even going to go into them, but here's the biggest one. The one that really got me is, it would make sense if temperatures are warmer, you get more rats. Rats thrive in exactly the same temperature as people do. And therefore, if the earth is warmer, it's better for people, it's better for rats. But that isn't what they did. In fact, when they looked at that, they got the surprising result that there was no relation. And in fact, it seemed like rats were doing better in places that were getting cooler. But they didn't look at how the temperature in the city had increased over the study period. And most of the increase in city temperature is due to the urban heat island effect. It's due to the fact they're paving over roads and running a lot of machinery and things like that. It's cities are heating up much faster than the globe in general. So the city is typically might be 5 or 6 degrees Celsius warmer than it was in 1900, even though the Earth has only increased about 1.5 degrees or less, 1.2 degrees Celsius. But they looked at the entire temperature in the region, so in all of Japan, not just Tokyo, or all of the Midwest, not just Chicago, how much that temperature had increased since 1901, which suggests the rats are, communicating over a region wide, measuring the average temperature, and remembering it since 1901 to decide, whether they're going to terrorize the population today. And if they had written it that way, people would have laughed at it. It wouldn't have gotten any media attention at all. But there it was. And this is the kind of wrong number. And by the way, that wasn't the only problem with the study. I do have to say, the guy who wrote the study was a really nice guy who spent a lot of time with me working through the data. One of the things I do whenever I read a study is I try to replicate it, because you don't understand what they've done until you can replicate it. And very, very rarely can I do it. There's always stuff the authors left out, that they did. But anyway, I worked with him, and he spent a lot of time, and we finally, matched all his results, and they were, what the data said. But his paper was silly. And it's not so much his paper was silly. It's the media coverage of the paper totally misunderstood the result. And frankly, he helped them do it by, he made some very careful statements that weren't literally false, but that sort of led the reporters down the wrong path.
And obviously, when there's an agenda behind something, they might find an answer that they're seeking.
Oh, you know that if he had said, climate change is ending the problem of rats, this would not have gotten any, or it would have gotten, coverage in a completely different, would have been on
The New York Post instead of the New York
the New
Times.
York Post or some of the some of the other places. But yeah, and this is actually something very interesting. It's not just about wrong number. Yes, the modern things is if you look at the big scientific frauds in history, they all have that character. They were things people wanted to find, and because people wanted to find them, they overlooked and expected to find them. They were willing to overlook all the problems with the study. And by the way, there's plenty of bad numbers, plenty of wrong numbers on left and right. It's not a partisan thing. It is a little bit of a populist thing that when populists, MAGA people, Trump people, some of the ultranationalists, things like that, they tend not to do scientific studies. They tend to just assert things. It is much more common on the non-populist or the elitist side to say, well, the experts say, because the experts are the ones who are writing these papers on the wrong numbers. You could make a video series making fun of populist claims, and in fact, I'm sure a lot of people do that. But that's so because I make fun of these wrong numbers from studies, the series kind of has a populist bent. And if I read the comments, I see there are lots of people who sign on who are just, oh yeah, the experts are lying to us again, And I mean, it is true. The experts often do lie to you.
Yeah. And it's like, how quickly does someone come to the conclusion is an indication of their interest in understanding really what's going on, Aaron, right? When you said you have to do the study to really understand it, back to 99.9% of the audience, no one's going to do that. You did the work. And and you obviously like it, or maybe there's a purgatory component to it that you're doing right now for yourself.
I'm hoping the book will change that. That's definitely true. The videos shocked me I've been writing this stuff for decades, but once some, slick production values got to get put together in a video, we got a million views on these and people watching the whole thing and people, going back and looking at all the other videos and things like that. And that just astounded me. But I do suspect, I don't want to say 99.9, but let's say 85% of the interest is just partisan. I agree with this side of the debate. But I'm hoping the book will
Oh, I see what
be
you're
more
saying. Right.
50-50.
Yeah. So my point also was that most people wouldn't do the work that you did, clearly. And now, yeah, you're saying that there's a growing, and I trust humanity. I have a not blindly, but I have an optimistic view that eventually, and maybe too long, people will eventually make the right decision and come back and, look to advance themselves, their community, and make thoughtful decisions that are with a long sight and not a short sight. So what you're doing advances that. So I'm in agreement. I think when you get people in a room, like what Bill said, as opposed to an email or when you speak to them or see them directly, you have a lot more surface area to get your point across. And the videos you do is much better than a PDF, I would imagine. Is that a fair statement as
Well, it
far as
gets a lot
access?
more attention,
Yeah.
but that has a pro and a con. Book you read. First of all, different kinds of people read books versus watch videos, but also, you're sitting here thinking about it. You kind of can agree with something. The videos carry you along, and they're designed to do that. You don't have time to really think. They flash some numbers on a screen and tell you, okay, this number is wrong, and you don't really have time to verify that. I don't notice people watching the video, stopping it, going back and forth and things like that. But again, we'll see how the book, whether the book attracts more of this. And by the way, I don't expect very many people to have my obsessive hobby of reading these papers and thinking about them. But what I do expect is people think, well, gee, because I'm showing glaring errors, things that when you think about it for a minute, you realize the study, either the question the study asked was ridiculous. I can't tell you how many studies there are where somebody publishes a number that nobody thought about, nobody gave a second's thought to yesterday, that suddenly they're trying to tell you this is the key thing that's, you should get really excited about. And people do, they get really excited about the number, but they never, nobody thought about it. And in a week, nobody will think about it. But at the moment, it just seems like the only important number there is. And for people just to be skeptical, studies doesn't prove anything. You got to say, okay, what study are you talking about, and exactly what did it prove?
I think you already just answered this, but what motivated you to write the book?
Well, so we sort of go back. So I've always been interested in this stuff. The success of the video thing is what inspired me to think, well, gee, maybe, a lot of people would buy this book. And it's what caused my editor, Bill Falloon at Wiley, called me up and said, hey, you're getting a lot of views. We should, we should do something about that. Then going one step farther back, the video series started, I don't know if you remember Chinatown buses, but, there was this a company called Funghua, started running buses,
Funghua bus,
curbside buses. Yeah. And what they do, the bus would pull up, you'd pay your $10, you'd get on the bus, and it would take you to Boston, Chinatown, from New York, Chinatown. So it was much cheaper. But the other big thing, well, it was more convenient too. Nobody wants to go to Port Authority, which is sort of ugly and crime ridden, and stand in line for tickets and make reservations and things like that. But also it was sold out, the times you wanted to go, the 6 p.m. bus or the Thanksgiving bus. So they were always full. Funghua just kept they just chartered buses and bring them up till everybody was there. So enormously profitable, and it started cutting into the profits of the big companies. And Chuck Schumer and Nadia Velasquez were trying to shut them down for years and years. And then there was this terrible accident, killed 15 people, if I recall. It was a casino bus. It wasn't a curbside bus. It was a casino bus that ran people from the Mohegan Sun back to New York, both ways. But so they got the NTSB to do a study, and it was a terrible study. and so I wrote a piece about it. And Jim Epstein, a producer at Reason Magazine, he was also looking into it. So we kind of collaborated on an article, but he was much better than me. He actually filed a Freedom of Information suit and battled with them for 6 months. It was complete. They refused to release the data, but he finally did find the data by accident. He was looking for it. They accidentally exposed it, and he found out their conclusion was curbside buses are 7 times as dangerous, and they had 37 fatal accidents. Well, it turned out they classified Greyhound and Peter Pan as curbside services. And 30 of the 37 fatal accidents they were blaming on curbside carriers were actually from Greyhound and Peter Pan. And they made a bunch of other mistakes. So I started doing these things for Reason. And then, they started doing the videos, and the videos were incredibly popular. And that's what led to the book. But I'd been writing articles like that Chinatown. But now I didn't find out the thing about Greyhound and Peter Pan. I just said, look, there are other big problems with this study. And incidentally, after the Reason piece, Bloomberg picked it up, and Bloomberg called up the NTSB, and they said, we stand by our study. Even though they were calling Greyhound and Peter Pan curbside carriers and blaming curbside carriers. And incidentally, 30 curbside carriers were shut down by the NTSB as a result of this study. They did not apologize or say, oh, yeah, oops, we're wrong. It's really all those fatal accidents are actually from the traditional carriers.
Yeah, so that's something we haven't talked about. Incentive structures loom large when you're trying to read a report. I imagine, Aaron, as far as...
Well, that's obviously true if you're reading from a lobby group, so of some size, but or some partisan group. National Transportation Safety Board, I kind of trust it. I mean, they want to stop traffic accidents, and don't we all? Everybody should be on the same side, and they're investigators. They know about these things. They have data on buses and fatal accidents and so on. So I don't think of them as something that's under intense political pressure that a senator and a representative can force them to issue a completely ridiculous report. I could, maybe they shade some of the wording, this and that to make them happy, but it kind of surprised me. Academics, there's a variety. I mean, typically you find academics on both sides of an issue, but yeah, there is, some issues that if you, vaccine research is one. If you want to publish a paper that suggests there's some danger to a vaccine, you'll get tremendous headwinds. You'll be threatened, you'll be this and that. That does, and by the way, vaccines have an enormous public health benefit. There's no, doubt about it. But there are individuals who can rationally decide their personal health is not to get the vaccine. The public health, it's almost always better if you get it, right? So if we're thinking the greatest good of the greatest number, we vaccinate everybody and we force them to do it. But if you're thinking about give people information so they can make the best decision for themselves, you can't get that information. And you can't get that information because there is this public health kind of, I don't know what you want to call it, attitude.
Prerogative or priority in process.
Yeah,
is probably
public
the right
health
way to look
people
at it.
just kind of think of the greatest good of the greatest number. In a sense, that's kind of their job, and they tend to be authoritarian. You kind of have to be, right? We for public health, we will quarantine somebody, taking away their right to liberty in conditions where they will almost certainly die. They're healthy now, but we're quarantining them with sick people. They'll almost certainly die. So we're taking away their right to life and pursuit of happiness. But we do it because if we don't, then a million people could get sick and die. So that's pretty authoritarian. We ignore individual rights and we do what the government wants. But there aren't very many things like that. There's pandemics, there's sanitation, maybe vaccination. Vaccination kind of in there. Vaccination is a very interesting one because some people benefit tremendously in personal health from the vaccine. The community benefits from the vaccine, but a substantial minority of individuals don't. Unfortunately, the people who don't get the vaccine aren't the ones who have done this rational calculation. They're the people who just don't trust doctors or the establishment or whatever. So when you publish something saying, there really is a danger with this vaccine for some people, that for some people might make them not want to do it, you end up getting a lot of people who should have the vaccine not to do it. And you probably don't reach the people who should. The extreme of this was the advice for the COVID vaccine for pregnant women, right? It had never been tested onto pregnant women when it came out. It would take years to know if it caused developmental difficulties in children. It took 5 years to figure out thalidomide was causing these problems. Now, thalidomide birth defects were gross and obvious. And by the way, the public health establishment fought this. It was a doctor in Australia, just an ordinary doctor in Australia who kept, worked through the pressure, kept insisting, and eventually got people to realize the terrible damage from this drug. So we're only now learning that it probably was safe for pregnant women. We now have children who are 4 and 5 years old whose mothers got the vaccine when they were pregnant, and we don't see any noticeable increase in birth defects or developmental difficulties and things like that. It's not, we'd like a couple more years to really be confident about this, but it's pretty sure. But still, from the beginning, from day one, the public health authorities were saying pregnant women should get this vaccine. And if a doctor doesn't recommend it, he can lose his medical license.
Yeah.
And any paper that says, we don't have any data out of this, and there are some possible dangers, we're going to suppress. And so there was a tremendous gamble done by the public health authorities, which seems to have paid off. And by the way, it is true. If you're going to get COVID, if a pregnant woman is going to get COVID, it just makes common sense that she's better off having the vaccine because all of the damage from the vaccine you're also probably going to get from getting the disease, plus a lot more. But someone who'd already had COVID, perhaps someone who had one vaccination shot, perhaps someone who, could guard against, could isolate and not be exposed, the calculus, and someone who was at relatively high risk of birth defects, these people could very rationally have decided not to get the vaccine, but they weren't given the data.
Well, I certainly don't always trust the government, but when I know for a fact that they don't have the data to do any study because it's a brand new vaccine being tested on humans for the first time, I'm at least going to question it.
Yeah, well, at least if you weren't a pregnant woman, they did test it on non-pregnant people. They did also,
true,
by the way, there were a few. Some of the people they tested it on did turn out to be pregnant, but none of them had given birth by the time the vaccine, came out and was done. And here's the really screwy thing too. The reason they didn't test it on pregnant women is they didn't want to risk, harming pregnancies. They didn't want to be responsible for those things. So it's too dangerous to test it on them. So let's give it to them. And it's too dangerous to test it on 100 of them. So let's give it to millions of them. But this is kind of the authoritarian mindset.
Well, thankfully, we haven't seen any bad outcomes. We would be, I think, remiss to skip a discussion on crypto. We know you're a crypto investor, Aaron. And before we talk a little bit more about that, I think Mark is going to give a discussion about Unchained.
Yeah, I think I'm going to also, Aaron, come back in and invite you. Yes, we are going to talk about our sponsor, a product that I use, their Unchained custody product. In our show notes, if you click it and go to the website, use our code NewBarPod10, you will get 10% off. I use it. I secure my Bitcoin because it's a bearer asset. And if you lose it, you're out. If someone else holds the keys and they lose it, you could be out like FTX, where you got $16,000 back instead of your coins when they were $65,000, something that few people talk about. So why are we talking about this, Aaron? All right, I'm going to show you two graphs, Aaron. Here is, and we're going to do like a minute or two on statistics and context. So we'll give a real life example about how you may look at performance of assets. And then I'll go finish up with Unchained. So we like to look at what I call the scorecard because it has, a couple $100 trillion worth of global assets here. You have gold, only 23 or 24 trillion. You have equities, I don't know, 150, 180, 150 trillion maybe. You have bonds that are 300 trillion. And year to date is similar to month to date. And it's also the same 1 year. So there's a pattern of precious metals and scarce assets leading, albeit smaller in size than the larger equity and bond markets. So that's one observation. Hold on one second. I'm going to go to one other picture. Two others, I lied. The concentration of that gain in the equity market year to date is really owes to these 7 companies.
I'm sorry.
So this is looking at 2025, 13.2% S&P up, but without these 7 names, the S&P is only up 6.5. So you've been in the market a while. I think it's fair to say that this concentration of 40% in the top 10% of names is even greater than 99, et cetera. I don't show that stat, but this is the performance. And we also saw it last year when the market was up about 25%. Over half of that came from just the 7 names. So this is where I'd like to look at data and why China is a big problem. I'm going to do 2 things, geopolitics and Bitcoin. The performance and the growth in equity capitalization globally has increased, potentially with money supply, but equities have been growing faster over time, mostly because of what's happening in the U.S. And China has been a little bit left behind as of late. They're not growing, so they're not participating in this game. And we bring that up. Part of what you said, Aaron, is get curious about maybe why things are happening. Why is China being so antagonistic? Do they have a lot of people and maybe we're locking them out of our markets, blah, blah, blah. But I like looking at data for this standpoint. So I'm going to stop right here for a second and ask you, do you get a similar take on it, something else, or is this data in by itself not enough for you to sort of launch into more research and discussion when you look at this?
Well, it's absolutely a starting point, and this is generally true. Data is a way to start a discussion, not to end it. The one big thing that may be missing from this is the real rate of return, because I think, that's been one of the biggest factors. So if you look at the yield on TIPS, Treasury inflation protected securities, that is sort of the real rate of interest that you expect to earn on a low risk investment after inflation. Because the TIPS, pay you inflation plus that yield. And, when you're going back to 2019, 2020, 2021, you have negative TIPS yields. And so for negative TIPS yield, you're actually paid to hold assets like Bitcoin and gold. and you're paid about $50 to $80 an ounce to hold an ounce of gold. Today, with the yields, with the positive yields around 2% or so, you're paying $50 or $100 to hold gold. Now, to me, that's a night and day, totally different. Gold is a totally different asset when real rates of return are negative versus when real rates of return are positive. So, you'd like to look at this. Another thing I like to look at. I
And
like to do
Aaron,
things.
and yet
Yeah, go ahead.
gold has accelerated in price, even though it's
Well,
there's an
it's
additional cost.
accelerated in price, I think, primarily because the amount you pay to hold an ounce of gold, if you include the storage cost or the ETF fee, if you hold it through ETFs plus what you give up for buying tips, that's actually been pretty constant, at least in the last 18 months or so. So gold is going through the roof, but if I think about it in dollar terms. What do I pay to own an ounce of gold? And that hasn't changed a whole lot. I also like to look at things in terms of Canadian dollars or Swiss francs because
Hmm.
a lot of what you're seeing here is a change in the value of the dollar, not a change in the value of the underlying assets. And again, you get completely different patterns. But you start looking at some of these charts and you start coming up with conjectures. Okay, what's really going on here? Is China, is the growth slowing down, or is there something wrong with the figures? And is equity market, are they in a bubble? A lot of
Hmm.
metrics. If you look at the CAPE, the cyclically adjusted price earnings ratio, things look like a bubble. If it is a Magnificent Seven. Are they, is this just a fad for the Magnificent Seven, and the actual stock market isn't really doing as well as it might look? And
Yeah,
we keep changing
I
the
brought
names
this
of
up to
stocks. Yeah,
show
go
you
ahead.
to your point about Swissy and the Looney, about the dollar being down 10% the first 6 months of the year, and holding that since first, biggest loss in, since the 70s. So to your point, right, there's a complex system, and I like how you said this might be a place to start, Mark, but there are nuances, and you prioritize real rates as a big one, and obviously that is the case.
By the way, if you're not thinking about, profits tomorrow, but you're thinking about the 22-year-old's life, real rates of return have been falling since medieval times. And, they were very high in medieval times. And a lot of the character of the medieval economy back in the 1300s was these very high real rates. Now it's not clear, they're barely positive, and we may well be looking at a long-term future with negative real rates, which would reverse a lot of economic rules. So that's another thing I think, but that's sort of a long-term thing. That's not something that's going to help you make money tomorrow.
No, but that's what I mean. Back to the point about why I'm with Unchained is, I want to be able to hold the asset myself. I do it multi-sig because I don't trust myself. So it's kind of a shared duplicative process, multiple keys, two or three, et cetera. And I agree with you. When you said that, to my head comes the degree of debt that's out there that drives some prices higher because of the money supply drive, and some prices are lower potentially because of not because of that, but because of technology. So when you say real rates are lower, can you tell like a 101 to our audience about what that really means from living your life and how it could change it?
So when real rates of return are positive, it means you can hold money in low risk forms. So you can put it in, a money market fund. You can buy short-term bonds. You can buy treasury bills, things like that. Or, buy real estate, things like that. And you can expect to make money above inflation. So get back more purchasing power than you got. When real rates are negative, you can't. You expect to lose money. You pay money to hold assets and do these things. And that's a big change to how you think about things. Back in the first, the inflation in the 70s that you mentioned, there was a law that said basically you can't earn interest on cash, or it was very limited, the amount you could do, and therefore the real rate that most individuals, most middle class individuals anyway, experienced was grossly negative. Was true, you had 12 to 14% inflation and 0% on your checking account, and that completely changed the way people think. And I'm a baby boomer, so I came to sort of financial adulthood in that era, and as baby boomers still kind of carry this idea around that, well, borrow money, borrow, because it'll be cheaper to pay back. Just like people who came of age, my father during the Depression, have the opposite: never borrow money. Borrowing money will kill you. And you get entire generations acting this way. Germans, a little older than my father, who were in the 1920s. Inflation is the one great worry for everything. So, if we get, but what saved the world were the money market fund. And by the way, money market funds and index funds, the other great innovation of the 1970s, didn't come from regulators. Regulators fought them. Regulators spent a decade trying to shut these things down until finally they were just so useful for people that regulators turned around and started embracing them. Now, with a money market fund, you can get pretty high inflation, but as long as the money market rates are higher than the inflation rate, you still have a positive real rate.
Wow. So looking forward, you think real rates will be lower, which means either there'll be financial repression where interest rates are artificially low, like they were kept, with negative 17 trillion in bonds, sovereign bonds at one point, and that the cost of goods that we're seeing, like you said, healthcare, et cetera, and in car insurance are going to be well above zero. And that would be a negative rate of return, real rate.
So as an individual, your only choice is to take risk. You got to go for risky assets, just holding. And by the way, it would undercut one of the big advantages of Bitcoin. But there are other kinds of crypto that are ideal for a negative real rate environment.
Right. And then, and in this environment, though, I think that Bitcoin benefits because of even though it's not cash flow generating, I think that its utility as as that next layer forget my opinion. You go into why you think Bitcoin wouldn't benefit from a risk-on financial repression negative real rate.
Well, if there's a negative real rate, Bitcoin has built into it a zero rate of return. Okay, and so if inflation is, and it doesn't inflate, so it's zero. But if in a negative real rate environment, everybody is running around trying to take risk. People don't want to park money in things. Maybe I should take a step back. I think I like the analogy of digital gold. And this is not how I've always felt, right? I first invested in Bitcoin back in 2011 because I thought it would be a transaction currency. But now I think it's just been completely, wildly bypassed by that. It turned out to be, they're much better crypto for that. But it's still the main way to get in and out of crypto. When I want to buy crypto, I first buy Bitcoin, and then I use the Bitcoin to buy the crypto. And if I have some extra crypto assets, get paid off in some crypto thing, I hold the money in Bitcoin until I can put it back in some other crypto. I mean, I do it because the value is relatively stable. I know people say that it's wildly variable, but everything else in crypto goes up and down with Bitcoin plus does some more things. So it is like gold, has no real value, no intrinsic underlying value, but it's been around a long time and people have faith in it, and therefore it's a good transition back and forth. Now, if we got a really sympathetic financial regulatory that totally embraced crypto, Bitcoin might not be so valuable because people could go directly from different kinds of crypto to dollars. But right now, it's the best way to get in the financial system. You can buy ETFs like Bill. You can do futures contracts on it. But so far, ETH is, sort of sneaking up a little bit, but it's just not got the same solidity and stability of Bitcoin. Now, if crypto takes off, Bitcoin takes off with it because it's just like, when the economy improves, people need more gold. And with Bitcoin, the only way you get more of it is for the price to go up. So you get more dollar value of it because the amount itself can't change. But if crypto becomes mainstream, if people just move over to and by the way, this is something I tell people, if you're going to invest in crypto, use crypto. If you can't imagine, if there's no way you can actually use crypto for anything in your life, maybe it's not really valuable for anything. Or if it is, you don't understand what it is. And if you actually use crypto, then you start saying, hey, you can tell, this is a pretty good idea. This is something people are going to want. And this is nonsense. This is not anything anybody's going to want. And so, yeah. And to Bill, I do recommend, I recommend holding it yourself. I don't mean to undercut your sponsor or anything like this. But again, if you don't hold your own Bitcoin, you don't really appreciate what it's supposed to be doing, right?
But to be clear,
yeah.
with Unchained, you do hold it. I hold both keys.
Oh,
They
okay.
hold a reserve key for you. So
I see.
that's the part. It's a 2 or 3 multi-sig, which, as you know, is part of the Bitcoin protocol. So they're just a backup. They can't move or access my coin. I hold them. They're just a reserve
Right.
in
And this,
a
by the
2 or
way,
3.
this is for, okay, so, 2016 or 17 to 2022 or so, almost all my investments were things like Unchained, were these cross-chain protocols and things that were, helping people do actual projects on crypto. Once I figured out Bitcoin wasn't going to be the transaction currency, that it was going to be Lightning or DigiCash, it was going to be one of these other things, or stable coins, then it became important how the crypto economy was working. But the other thing I tell people is, 90% of the media coverage is on the ups and downs of the Bitcoin price, which have as much to do with what people think of dollars as they do about what people think of
Yep.
Bitcoin. The
What
real,
you just said there,
yep.
Aaron, we're going to put in a short because no one appreciates that. They're just looking at the denominator, at dollars themselves. Sorry to
But
interrupt you.
but the real thing is, what are people building? And they're spending at this point about $300 billion on actual infrastructure, on servers and code and things like that do useful things. And that's what, ultimately, I'm a fundamental investor to that extent. You want to invest in things that are real value, that people are really paying dollars for. Granted, at the moment, it may not be that many people. It may seem kind of like a niche application, but it is so much better than the current application that it has to catch on. And once the network effects kick in, then you can have an explosion. I liken it a little bit to back in 1995. If you wanted to invest in the internet, there was one stock, Netscape, and it was the only way. So Netscape goes to the moon, not because people thought, gee, browsers are the secret of the future, or Netscape is the best browser. It's the only way you can get in. And for a long time, that was kind of true of Bitcoin, or at least Bitcoin was by far the easiest way to get into crypto. But today, you got a lot of opportunities, and you can find real operating companies that are doing real economic work and hold those coins.
Yep. And to the audience that we speak to, what we like to do, or I like to do, is distinguish what I think is a distinction is that all the other cryptos have tremendous technologies. During 2022, I think the on-chain Sushi or Uniswap had no failures in its liquidations. So those things worked. Those on-chain DeFi things worked. God bless them. What people, I think, in Bitcoin look at it, what I look at it is that to be truly decentralized in a world where there might be more encroachment might be worthwhile to have something that is outside the purview of anyone getting a Wells notice, anyone trying to capture. So that I think it's the only one that has escape velocity on that trilemma of decentralization, security, and then that last part, which they haven't done, which is scaling. Like, to your point, it's definitely a piece of rock that has yet to be formed as easily, and it's hard to fund businesses when you have that.
Yeah, I don't know if by the way, the history of crypto that was into the stuff back in the 80s. The original impetus was the people who want to live forever, who, going to freeze themselves before they die. And the original impetus was, okay, how am I going to keep my money, right? If I put in a bank account, well, the bank could fail, or it could be stolen, or courts could award somebody this and that. The only thing that I can be confident of is something in my head. They have to revive me to get the key. Now, they might revive me and hold a gun to my head and say, give me your key, but, okay, well, you can't do anything about that. But so they didn't trust lawyers or banks or trust, if you think, well, 500 years ago, what could you put your money in 500 years ago, or would it still be, safe today with you, unconscious the whole period? So this is a sort of solidity some people want, right? They know, any money in the bank, well, gosh, any bureaucrat waving a piece of paper, anybody can go to court, can seize or freeze or block or tax or embezzle, but, you got a private key. And that's, well, except for quantum computing. That's the big dark horse there.
That's our next podcast with you there, Aaron.
Okay. I don't know if you saw, by the way, but there's a team just announced they had 1,030 qubits running for 2 hours, which is that's the kind of performance where you start being able to crack a Bitcoin private key.
Yep. And everything else that's out there in the world.
And everything else that's out there in the world. But Bitcoin solely relies on that. That's all it's got. The banking system, if crypto security in the banking system fell apart tomorrow, you'd have a giant credit card bill and you'd have some, people would have to argue for about a month to sort it all out, but it wouldn't all be gone. Bitcoin would evaporate unless they can get a technical fix. By the way, I think proof of work is, it was a great idea to get started, but it's a technology whose time has passed. So we already have plenty of cryptocurrency that is not can survive quantum computing.
We're going to totally disagree on that, and that's going to come up in our next podcast as well.
Okay.
This is going to be a good one, Aaron. We're setting it up again. Good stuff. Only after I read your book, Aaron.
I was going to say, I think that would warrant another half hour, and we're probably a half hour longer than usual, which is great. It happens very quickly when we're having a good discussion. So thank you, Aaron. Can you just tell our listeners where to find you, where to find the Wrong Number series?
Well, I have a website. My website is eRaider, ERAIDER.com. So E and then the word Raider. And then you can go to YouTube and look for the Wrong Number series. I'm working on setting up a Substack for basically to publicize the book and do things, but it isn't up yet, so you can't find me there. And, you can go to Bloomberg. You can, I publish columns there once a week or so, and my email address is up there.
Perfect. Been a pleasure, Aaron, and we will definitely look for your book. I've already gone through YouTube and looked at some excerpts on Ratapocalypse. Did I pronounce that right?
I say retpocalypse, but I don't know that it's in the dictionary yet.
Ratpocalypse. Okay.
Yeah, you need to combine two words rather than.
Well, we'll see. We'll see what takes off, if it becomes a word at all. I made that up, by the way. That was not, the author did not call it ratpocalypse.
Well, we will also put the links in the show notes for the video series as well as your website. But it's been too long, Aaron. I hope we get to catch up again sooner rather than later. And like Mark said, you're welcome to come back anytime.
Thanks very much. Goodbye, everybody.
You bet. Take care, guys. Hey, guys. If you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.